Everybody, thank you for joining us today. This is a regular meeting of the planning group, or excuse me, of the finance group. And if you're not a member of the finance group already, please join it, and we'll get you more information about training opportunities like this. I'm happy to have with us today David Imus, who is of the of Whipley, and most of us know Whipley and the reputation for being pretty good with accounting. So we've asked them to come on and give us some instruction on lease accounting, which came up out of our last quarterly meeting. We are recording today's session. So anybody who was not able to participate, we'll go ahead and send them the recording. And as David was mentioning a moment ago, a copy of the presentation. So David, without further ado, let's get into some lease accounting.
Sounds great. So thank you for the great introduction, Lawrence. Again, I'm David Imus. I'm a senior manager here at Whipley. I'm on the Whipley's kind of lease task force with the new lease guidance. So it became necessary, to continue as a trusted resource for our clients to create a task force of people who are really willing to get in and get our hands dirty and really understand the ins and outs of the lease standard. So as part of that, part of what I do is quite a bit of internal firm-wide training and also external facing training like this on lease accounting for both governmental and non-governmental entities. So today we're going to be covering the non-governmental side, which is going to apply to you guys. Apart from being on the lease task force, I also serve on Whipley's National Accounting Standards Advisory Group, which advises the standard setting boards like the FASB on new accounting pronouncements. And I'm also the chairman of the healthcare technical issues committee here at Whipley, which wrestles with how to apply US GAAP and generally accepted auditing standards with respect to healthcare clients. And I'm also a member of the governmental technical issues committee. So that's kind of the world I live in, is US GAAP and matters affecting financial statements. But lately, the last year or so, I've been really focused heavily on the lease standards. So hopefully, if you guys have any questions, I can answer them. If you don't, then I will definitely circle back and get you the right answer, because there's really a lot to this. So we have just an hour together, so there's a lot of information we want to cover. We're going to cover what constitutes a lease, do some compare and contrast between the legacy lease standard and the new lease standard. So anytime you see here this ASC 840 and ASC 842, ASC just stands for Accounting Standards Codification. It's kind of like the card catalog for where you find the gap for a particular topic area. So just, I'm not sure everybody's background and experience, but we kind of throw that around there as it's just kind of a known acronym, but I always like to clarify that. We'll review accounting treatment and transition methods. We'll talk about practical expedients that are available to reporters, financial statement reporters, and we will look at transition guidance and calculations. So those are our objectives, which, as you can imagine, tie directly to our overview here, kind of a roadmap. So first, before we do anything, we're going to have to learn what a lease is. And I'm going to actually move through this fairly quickly because I want to spend a little bit of time on some of the illustrative examples and really the nitty-gritty debits and credits for lease accounting, because I think that's where a lot of people's minds are, is how do we know how to journalize these transactions under legacy GAAP, under the new GAAP. How do we journalize the transactions? So we'll definitely get to that, but before we can get to that, we have to understand what's in scope, what's out of scope, what's a lease, what isn't. It's also important to know the effective date. So fiscal years beginning after 12/15/21 fall under this guidance. So any reporters that are 12/31/22 reporters, that's the first year that ostensibly you'd have to report, unless you're a public entity, which I don't think any of us are. None of us are traded on a national exchange or anything like that, or unless you chose to early adopt. So we just have a slide here, and like I said, I'll make these slides available just to kind of take you through kind of the saga of lease activity and all the accounting standards updates, which kind of fed into topic 842, which is the new lease standard. So we just listed those out just to kind of show you just the unprecedented amount of activity that's gone into this new lease standard. So we won't cover each one of those in detail, but I wanted to list those out just to kind of give you an idea of how hard the FASB has been working on this standard. So without further ado, we'll get into definition of leases. So we have 4 parts to this definition. This is straight from the guidance. It's a contract or a part of a contract that conveys the right to control the use of identified property, plant, or equipment and an identified asset for a period of time in exchange for consideration. So the 4 parts we have from that is a physically distinct identifiable asset. We have this concept of time. Does the contract have a term to it? We have the concept of control and the concept of consideration, which is the payment, which most likely is going to be cash, but as you'll see, the guidance leaves room for non-cash consideration. So if you have a contract that's delineated in something other than cash, then that could still contain a lease. So we're just going to unpack these relatively quickly. The first one has to do with an identifiable asset that has to be physically distinct. So and the supplier cannot have substantive substitution rights. So if you're renting, say, aerial man lift on a construction site, but you're renting it from United Rentals, and United Rentals can come get the one you have and replace it with another one to benefit themselves at any time, then they have substitution rights. You don't have a lease at that point because you don't have a specific asset that you're leasing. You're just renting a piece of equipment for the day, basically. So to help kind of illustrate this, we put together a little bit of a fact pattern. Hans and Franz LLC has developed a new fitness app. To help with the extra online traffic, Hans and Franz enters into a contract with IT Serve Company to use one of their servers for a 3-year period. IT Serve Company, which is the lessor, delivers and installs the server at Hans and Franz LLC's new headquarters and will provide repair and maintenance services as needed. If it malfunctions, the lessor will replace the server with an equivalent one. Hans and Franz will be responsible for the decisions associated with data storage and is responsible for integrating the server into its current IT infrastructure. So, do we have substantive substitution rights? First of all, there is an identified asset, that's the server in this example. Replacing the asset is a matter of repairs and maintenance. And so really it's not really, we don't really have substantive substitution rights here. What we really have is just kind of a loaner agreement. And it does not economically benefit the lessor, IT Serve Company. So I think we can conclude that substantive substitution rights don't exist. So we do have an identified asset, and the lessor does not maintain, they can't just go on site and swap out that server at will. It's only if it malfunctions, and it's only temporary during the time of repair. Another piece of information on a slide that I kind of took out for the sake of time notes that substantive substitution rights probably don't exist if they're difficult to identify. You kind of know it when you see it. So in this case, we can't really see that there's substantive substitution rights, so we can conclude that there are. So next, again, we have 4 criteria in order to identify if a contract or an agreement contains a lease, and the second one has to do with control. So does the lessee have the right to obtain all the economic benefits? So we have some steps to determining what this looks like. Is there exclusivity? Do you have to share the asset with somebody else, or can you maintain all of the, or do you, I'm going to go ahead and shut off my camera because I'm getting a few little glitches with my bandwidth. I hope that isn't coming through on your end, but hopefully that helps conserve bandwidth a little bit. But does the contract have exclusivity? If the contract has exclusivity, then that's one element of establishing control. Can you identify the units of measure to measure economic output? So this is kind of, if you're leasing a machine, for example, are you able to use that machine to produce as many widgets as you want, or no widgets at all, or just widgets on Wednesdays? If you don't have that right, then you probably don't control the machine. If you do have that right, that's another element of control. And then you have to evaluate whether any other party has a more than an insignificant portion of the economic benefits. So if any other party gets the benefit of using that machine, that's more than insignificant, then it's doubtful that you have control. So continuing with this element of control, so a lessee or a customer would not control the asset if another party has more than an insignificant portion of the potential benefits. So economic benefits can be evaluated by the use of asset to produce the goods for its own use or resale, provide services, or enhance the value of other assets. Maybe the machine just fixes other machines in the factory. So in order to have control, the lessee must have the right to direct the use of the asset. That's what I was talking about earlier with like the widget example. Can you direct that asset to create widgets? Can you direct the use of that asset to create doorstops maybe? Does the customer have the right to direct the use in the following situations? Can the customer direct what it's used for and make determinations about what purpose that asset is used for? Again, like I said, can you make a determination of if you're going to create what the output of that machine is going to be? If that's present, then that establishes control. So I feel like we have another slide here on control, but I feel like we beat up control pretty well. This one is fairly easy to understand. You kind of understand if you control the asset or not. And we've given some examples there. Period of time is pretty easy concept to understand. If you have a 3-year agreement, there's your time element. As we'll see as we get into kind of some of the accounting for leases and how to calculate the lease liability and what the lease term is, that the non-cancelable term is, time is a really important element to the accounting. But for the purposes of just day 0, we're just trying to go through our portfolio of agreements to determine which ones contain a lease and which ones don't under this new standard. If the time element is there, that's another element that has to be in place in order to understand if you have a lease. Consideration, that's another fairly easy one. Doesn't have to be cash. Most often it's going to be cash. But what are you giving in exchange for the right of use of this asset? So again, the four elements are an identifiable asset, control of that asset, the concept of time being present, and consideration. So we're going to talk a little bit about embedded leases. These have always existed, but under the legacy lease guidance, the pre-12/15, 2021 guidance, which is ASC 840, these were no big deal, right? Because what these were is like maybe a purchase contract that came with the use of a piece of equipment to, process the supplies or process the inventory that you were purchasing. These types of agreements have always existed, but they were kind of no big deal under legacy lease guidance, in which operating leases just resulted in a period expense. There was no balance sheet impact whatsoever. There was no asset or liability recorded. As we'll see, the treatment under ASC 842 is significantly different, because what we have to do, as we see kind of as we progress in our training today, we have to evaluate all of our agreements, regardless of whether they're nominally called a lease or not, to understand if they contain a lease, which may be embedded in a different, maybe in a service contract or maybe in a supplies contract. And then we have to pull out that lease and apply lease accounting to that portion of the agreement. So these agreements, which before, really might have only resulted in supplies expense, if they had a lease contained in them, it's kind of like, oh, well, because that would have just been rent expense anyway. So everything's getting expensed no matter what. Now we have to reach into those agreements and determine which portion of that agreement is attributable to the equipment and which is attributable to non-lease components like service or supplies or that sort of thing. And then as we'll see, if it's determined that that agreement has a lease contained in it, there is a practical expedient available to us to where we can just apply a lease accounting to the entire arrangement to keep our lives a little bit simple. But we do have to evaluate that contract to see if a lease exists to begin with. But before we do that, we're going to take a quick trip down memory lane to look at the changes and similarities between ASC 840 and 842. So here on this slide, we have the two different definitions of a lease. The definition I've already given to you is this bottom bullet point. The legacy definition is an agreement conveying the right to use property, plant, or equipment, usually for a stated period of time. And so when we unpack these definitions, we have them listed out side by side here. We have an agreement, both are yes. An identifiable asset, both contain that. Control the asset, yep. Element of time, yep. Element of consideration. So the definition is essentially the same. Why do we care? Why are we spending all this time unpacking this? So if you take nothing else away from this training, if you listen to nothing else, if you pay attention to nothing else, come back to your computer now and listen to this particular slide. Operating leases under the legacy lease guidance, which is ASC 840, as I mentioned before, only impacted your income statement. They resulted in just rent expense. And then remember, in our financial statements, we just had to have a disclosure disclosing the non-cancelable period for those operating leases. Operating leases will still exist under 842, but they will now have balance sheet impact. They'll result in a lease liability and then a right of use asset coming onto the balance sheet for the future principal payments associated with that lease. So the old lease standard has a concept of capital leases and operating leases, which is a framework we're all super familiar with. The new lease standard maintains that kind of dichotomy, that two type of lease framework. But instead of capital leases, now we have finance leases, which are basically the same thing as old capital leases. So most of your old capital leases, as long as you did your job in the period that you originally accounted them for, are just going to become finance leases now. The codification just calls it finance leases now. I think because now all leases are going to be capitalized, I figured it'd be inappropriate to call some leases capital leases when all leases are being capitalized. And then operating leases, we still have the concept of operating leases nominally, but they're also, like capital leases or finance leases, are going to result in a liability. So this is kind of the slide that I kind of stole my own thunder on, but this is the kind of main takeaway for this entire training is the impact on operating leases is huge. The accounting for operating leases and finance leases is going to be a little bit different, but the main takeaway is that we're going to have to evaluate all those operating leases for capitalization and potentially take some of those operating leases and put them on the balance sheet as a liability. So what does that look like in terms of debits and credits, the overall accounting impact and treatment? First of all, we have to, before we figure out the accounting, we have to figure out the classification, because as I mentioned, we have a two lease model here with finance leases and operating leases. So in order to determine if you have a finance lease or an operating lease, you need to do that step before you determine what the accounting is going to be, because accounting is going to be a little bit different. So there are basically 4 similar criteria that existed under the legacy lease guidance with an additional criteria to consider. First of all, if the contract transfers ownership, full stop, it's a finance lease. Any of you that come from a governmental background, this is a major difference between the non-governmental and the governmental guidance, because contracts that transfer ownership are not leases for governments. So just something to be aware of, you know, if maybe you're new in your role and you came from, you know, a city or county government or something like that. So the GASB guidance is a major difference there. If there's a purchase option that's reasonably certain to be exercised, generally less than fair value, we can assume it's reasonably certain to be exercised. If the contract spans the majority of the useful life, so this used to be the 75% test. They took the bright lines out of the guidance this time, so there's no longer the 75% threshold. It just says a majority of the useful life. So I think we can interpret that to be 51%. So if you have an 8-year asset and you have a 5-year lease, that's over 51% of the useful life of the asset. That would meet the majority of the useful life test. And then if the present value of the future minimum lease payments is substantially all of the fair value. Again, this used to be called the 90% test, because we had a bright line available to us in the lease guidance. The bright line was 90%. So if the fair value of the equipment that you're leasing was $100,000. And if you took all of the future payments, discounted them to present value, and you came up with $95,000, then the guidance says you substantially bought it. It's a capital lease. You go ahead and capitalize it. Now the lease guidance says substantially all, not 90%. So that's an opportunity for each and every one of us in this room right now to go back to our accounting manuals and our policies and update it to define where the guidance doesn't define it for us. We have to define that for ourselves. Are we going to stay with 90%, which is what we've always done? If so, great. That's allowed to you. But it's just a gray area that our policies will have to go back and fill in the gaps and gap. And then the new one is if it's specialized in nature. The idea of being there is if it's so specialized that the equipment was built for you or tailored or customized to you, it's something you're probably you're really just financing, as a purchase agreement as opposed to a rental agreement. So then you have a finance lease. So really similar classification criteria. If you meet any one of these, then you have a finance lease. If not, then you're back into operating lease territory. Now we're getting into the nitty-gritty of how to kind of do some of this accounting. So the lease liability. So right now we're still, in terms of our lease saga, our lease journey together, we're still on day zero, our day zero accounting. So far together, we've determined, do we have a lease? We've looked at all our agreements. Do they meet all the 4 criteria? Are there leases present? Then we've taken those agreements that we have that we determined to be leases, and we've run through the rigmarole of determining, do we have a finance lease or an operating lease? Once we make that determination, now we can be here. But again, we're still on day zero. We're not up and going yet with our full day-to-day accounting yet. But first thing we need to do is measure the lease liability. And I talked a little bit about how these agreements are going to generate a lease liability and an asset. A lot of the accounting here is going to be driven off the liability. So it's really important to kind of assess the liability first, because a lot of the asset accounting is going to follow that. So first of all, we're in the measurement stage. We're going to measure that lease liability. So whether or not you have a finance lease or operating lease, at this point, it doesn't matter. The measurement of the liability is the same. It's going to be the present value of the lease payments not yet paid, discounted using the discount rate for the lease. Variable payments are not included in the calculation unless there's a required minimum. So what does this mean? This means if you're leasing space in a mall to a store and you're leasing it for $5,000 a month plus 5% of gross sales, $5,000 a month is the monthly minimum. That goes into the lease liability calculation. The 5% of gross sales doesn't. That's variable consideration. But if you have a lease for office space for $5,000 a month and it goes up 3% every year, that's an escalating clause. That's different from variable payments. That's known at the time of the lease. That'll factor into this math that'll calculate our lease liability. So we take all those payments, we sum them up out into the future and determine what our non-cancelable payments are on a cash basis. Then we have to discount those to present value in order to reflect the fact that we're gaining use of this asset today, but getting the benefit to pay over time. So what discount rate do we use? You use the rate that is implicit in the lease agreement. So if the lease agreement contains an interest rate, you just use that rate, full stop. Doesn't matter what your policy is otherwise, in all cases. If the agreement doesn't include an interest rate, but it does have an implicit rate, what does that mean? Well, a lot of agreements I've seen will have like the least value of the equipment and it'll be substantially lower than what your total payments are. Well, that means the spread between the value of the asset that you're leasing and the total payments, that difference is your discount rate. So you just have to plug that into a present value calculator and just kind of squeeze out what the interest rate is using math to do so. So that's what we mean by an implicit rate. So if neither of those two things are present, in the case with building leases, very, very rare to ever see an interest rate in a building lease. Then we have to use what's called the incremental borrowing rate. And so the incremental borrowing rate is what your entity can borrow at today for a similar loan with similar terms. As you can see, we'll have some slides on this when we talk about practical expedience, but one of the practical expedients available to financial statement reporters is, if you don't want to go through the rigmarole of figuring out your incremental borrowing rate, you can use the risk-free rate of return, which is kind of like analogizing to like a U.S. Treasuries rate or just a published rate that's out there. So we'll kind of break that down in a little bit, but that covers the lease liability. So we know what the payments are; those are in the agreement. We know what the term is. We'll cover that in a little bit and how to kind of pin down that term, and then we take that interest rate, we plug it into our present value calculator, our time value of money calculator, and we get the lease liability. So these last few bullet points here just talk about if you are using an IBR to estimate your discount rate, or you're analogizing to the risk-free rate, the rate we use might be different for different leases, because leases will have different terms associated with them. And so it would be inappropriate to use like a 1-year line of credit discount rate on a 5-year equipment lease, because as we all know, the interest rate risk on a 12-month agreement is much different than the 5-year interest rate risk. So it's understood that a 5-year rate is probably going to be higher than a 12-month rate because of the interest rate risk involved there. So just a little bit of a tripwire in determining the IBR, or the discount rate. So as I mentioned before, once you figure out your lease liability, which is the second bubble in this kind of right of use asset journey, then we can figure out what our right of use asset is. So the right of use asset, again, like I mentioned, you're going to credit your liabilities for some sort of long-term lease liability. You're going to debit assets for a right of use asset, and that asset is going to be, like I mentioned, it's going to be driven by the lease liability. It's going to be equal to lease liability plus any initial direct costs, plus any prepaid lease payments, minus any lease incentives received. So it's possible that your right of use asset is going to be different than the lease liability. But in a lot of cases, if you don't have any of these 3 subsequent bubbles here, the initial direct costs, prepaids, or lease incentives, then your right of use asset is going to equal exactly what your lease liability is. And what we're seeing in practice is that comes up quite a bit. So we talked about the definition of lease, and we took you through how to determine if you have a finance lease or if you have an operating lease. So if you determine you have a finance lease, we're basically this accounting should look really familiar to anybody who's already doing capital lease accounting, because it's very, very similar to just straight up loan accounting for purchased assets. You're going to record the lease liability. You're going to record the leased asset, and then that's your day zero accounting again. And then as you go down the road, the cash payments are going to result in a reduction to the lease liability. So down here, starting down here at the bottom, I'm not sure if you can see my cursor or not, but the very last row of this journal entry is the cash payments just going to be whatever is in the agreement. And then that's going to result in a reduction of the lease liability based on your amortization table, because remember, we discounted that to present value. The spread between that and your cash payment is going to be charged or debited to interest expense. So you're going to recognize interest expense instead of any sort of rent expense. And then in order to reduce your, or amortize, sorry, in order to amortize your right of use asset, similar to fixed asset accounting, is you're just going to straight line in most cases your amortization expense for the month or for the year, whatever period we're talking about here, and credit accumulated amortization. So that right of use asset will, just like straight up fixed asset accounting, the cost basis is going to stay intact, and it's going to be offset by this accumulated amortization as you amortize that over time. So just a couple things there. You can really choose any method you want for amortizing. You can use some of the year's digits. You can use some sort of accelerated method. 99.99% of my clients are going to use straight line. The only thing the guidance says is it has to be over the shorter of the useful life of the asset or the lease term, which again is most of the time going to be the lease term, because why would you ever lease an asset for a shorter period of time than you think it's going to last? So on operating leases, this calculation, again, this day zero accounting of the lease liability and the right of use asset is exactly the same. It's the present value of the lease payments not yet paid discounted using the rate established at commencement, so it's discounted at present value. No interest portion, as we will have rent expense in this case, as you'll see as I kind of take you through the journal entries. And then the right of use asset is just going to be back to that thinking back to that graphic a few slides ago, where it's the lease liability plus or minus indirect costs, prepaid rent, lease incentives, those sort of things. And then lease expense is going to be recorded straight line over the term of the agreement. Or you could take the right of use asset and accrete interest on the liability each period. So this is where it gets a little bit confusing for me for a couple of reasons. Is first of all, this is kind of new accounting for us because we're used to operating lease accounting, where it's just simply, the cash goes out the door, we credit cash, we debit rent expense, and we're used to the finance lease accounting, the bottom of this page, because that's what we've been doing for years now with the capital leases. Operating leases are a little bit different, and I also deal with a lot of governmental entities which their standard doesn't have operating leases. So this is I always have to kind of revisit this and get grounded with it. But these are our facts. Is we have a lease that commenced on, and then this is really important to kind of try to keep up with this example, because this unpacks a lot of frequently asked questions in one really slick example. So we have a lease that originally started before the standard took place on January 1st, 2019 for a term of 5 years. The agreement provides for one renewal option. So the agreement says 5 years with 2 extra years if you want. Management has determined that as of 1/1/22, which is the date of adoption for the new lease standard, that ABC Company is reasonably certain to exercise that new renewal option. Now, we haven't really covered the lease term yet, but just to kind of give you a preview on that's important. Is the lease term is the nominal term in the agreement. It's whatever the non-cancelable term is. So in this agreement, it's 5 years, plus any renewal options that are reasonably certain to be exercised by the lessee, less any termination options that are reasonably certain to be exercised by the lessee or lessor. So this is a really tricky thing for a lot of my clients to understand is how do I assess these renewal options? And I kind of have to put it back on them and say, hey, how sure are you that you're going to renew? If they're reasonably certain, that's a really high threshold, by the way, maybe 85, 90% certain, a lot more certain than more likely that if you're reasonably certain you're going to stay in this agreement, then you're reasonably certain. You don't really have a 5-year lease and you have a 7-year lease, right? Monthly payment is $5,000 monthly, which covers rent payment of $4,500 and CAM charges of $500. You'll see why that's important here in a second, because we have an agreement that contains $4,500 a month of lease transactions with a $500 a month non-lease component. The lease was appropriately classified as an operating lease at its inception back under the legacy lease guidance and has no initial direct costs. So what does the accounting look like? At adoption, again, our day 0 accounting, the adoption date is 1/1/22. So the adoption date is going to be the later of the adoption date or the commencement date of the lease. So what the standard says is the facts and circumstances that it existed on the first day of the first period that you're presenting in your financial statements. So this first day of these 2022 financial statements is going to drive a lot of the accounting. So we have to look at the remaining term, because everything that was before this 1/1/2022 date was appropriately accounted for under legacy GAAP. We don't have to do anything with it. So what does that mean to our accounting? Well, the lease term is a 48-month lease. How did I get 48 months? Well, you had 3 years that already expired and were properly accounted for as rent expense under ASC 842, or legacy GAAP. Under new GAAP, under our new lease guidance, we have 24 months on the original 5-year term, plus the renewal period, which we're reasonably certain to exercise. That gives us a 48-month term. So everybody should be comfortable with how we arrived at the lease term. Monthly payment is $5,000. We'll take you through what the elections that are available to you in the year of adoption and otherwise, but one of the elections is to not separate out lease and non-lease components. Remember when I was talking about embedded leases? What we have here is we have a lease agreement that's on its face a lease agreement, but has these CAM charges, these maintenance charges of $500 a month. The client has elected, we're not going to do separate accounting for that $500. We're just going to call it all lease. That is an election available to you. So in order to simplify their accounting, they've made that election. So our totally monthly lease payments, our bubble's a little bit off here, is $5,000. Our payment frequency is monthly. Classification is operating. One of the elections that entities have is to roll forward their elections, that if a lease was properly accounted for in the past as an operating lease, and a lease was properly accounted for in the past as a capital lease, those elections, as long as they were done right in the first place, can be rolled forward, and we don't have to reassess them in this year of adoption. We can just roll them forward, and old operating leases can just be new operating leases. Old capital leases can just be finance leases. So that's how we come up with the classification. And then, as with most building leases, we don't have a discount rate. They don't know, there's not an implicit rate in the agreement. So they're just they're going to elect to use the risk-free rate. So this bottom dialog box here just talks about that election that I mentioned, where old operating leases can be new operating leases, the same with capital and finance leases. But if you made an error in those classifications in a prior year, it doesn't mean you can just carry them forward. You have to revisit those ones. So you can't grandfather in errors, but if you did it appropriately, you can roll it forward. That is a part of the package of 3 practical expedients, which we will cover today. So your day 0 accounting is going to be we're going to start with the lease liability. The present value of the 48 monthly payments, and anybody with a finance calculator can follow me along. I've done it, it works. Discounted at a rate of 0.995% is going to be, that's how we determine what our discounted future cash flows are. So, you know, our $5,000 a month times 48, those are our undiscounted cash flows. When we discount those to present value, I think I did minus instead of times. So our undiscounted cash flows are $240,000. That's what we're actually going to be paying out in cash. But when we discount those to present value, again, you can follow along with a finance calculator or a spreadsheet, but you'll get 235,386. So you credit lease liabilities for 235,386. So we know this bubble here is 235,386. Now we have to figure out what our right of use asset is. Well, we don't have any of these 3 indirect costs, prepaid lease payments, or lease incentives. So in this case, our right of use asset is going to be 235,386, which is the original lease liability plus or minus $0.00, because we don't have any of these things. So this is going to be one of those cases where I described where our right of use asset is going to equal the right of use liability. So this is the journal entry to bring that on the books. You debit assets for 235,386. You credit liabilities for 235,386. We're happy. So now the rent payments are due on the 1st of the month. So in this case, what we're going to do is we're just going to take it out of cash. Could also be AP, but cash, $5,000, and we're going to just hit the lease liability for the entire amount, $5,000. But we also have this right of use asset that we have to figure out. So we've reduced the lease liability for $5,000. The interest is going to be calculated on the lease liability balance of 230,386, which is the discounted future cash flows. Now it's not the $240,000 of the undiscounted cash flows. So $235,000 less 5,000 is going to be 230,386. That gives us our new liability balance. If you multiply that, I've done the math on this. So $230,000 for 86, which is the new liability balance less the cash payment at the 1st of the month, times our interest at almost 1%, 0.995%, which is our discount rate we used by getting the weighted average of a couple different discount rates, right? And then dividing it by 12 to get our monthly, you get $191. So our accreted interest in this case is going to be $191. So that's how we figure out the adjustment to the right of use asset. Because remember, our right of use asset is not $240,000; it's the $235,386. So the right of use asset is going to be adjusted by 4809. How did we get there? Our cash payment of 5,000 minus the $191 of accreted interest. So that's the amount by which we reduce our right of use asset. So we don't recognize any sort of accumulated amortization here like we do in a capital lease or a finance lease type of situation. We just hit lease expense or rent expense, if you will, for this $5,000, and then we just directly credit the operating lease asset, the right of use asset, the capital type asset that was booked. We reduce that by the amount of the cash payments less this accretion of interest of $191. So we just put that back into the liability so that the amortization of the liability works out. So putting that all together, first of the month, first day of the first fiscal year presented, we generate our discounted future cash flows, give us a lease liability of 235,386, 235,386. You record and reduce you record a cash payment to reduce the liability on the first day of the month, which is typically when building rent is due, is the first day of the month, by $5,000. So you get cash for $5,000. You debit an expense for $5,000. And then at the end of the month, in order to true everything up, you have this lease expense of $5,000, and you reduce the lease up. You reduce the leased asset by 4809 so that it gets amortized down properly, and then you put that 191 back into the lease liability. So this is a lot more confusing to me, at least, because it's kind of a new concept or a newer concept. It's not really, it's not a new concept at all, but it's new to this kind of transaction stream. And then if we had this kind of an amortization schedule, you'd be able to follow along. But the next month, cash is just cash. You just do the same $5,000, and then the math just changes a little bit because of your accretion of interest is going to go down a little bit as your accretion of interest is going to go down a little bit as that balance goes down. So I'm actually going to seeing some questions come in. So I won't identify or call anybody out here, but I'll go ahead and read it out loud. On example 1, what if the CAM charge increase everywhere but not a fixed rate? So this brings up an excellent question. I'm going to actually spend a little bit of time unpacking this because I wanted to spend the most amount of time possible on this example, and I think we got through that. If there's other material maybe we don't get to, you guys will have the slides, but I really wanted to, you guys are all finance professionals, I wanted to really show you this example. But the question is, example 1, calculation. What if the CAM charge increases every year, but not at a fixed rate? So if it's 510 in the first year, 515 in the second year, how would the calculation work? If those are known in the agreement, then those would just get built into the present value math. So when you go into your present value calculator or your lease software, whatever you're using to your spreadsheet, whatever you're using to generate these calculations, you would just bake that in, because what I call those are variable fixed. These are my words, not FASB's, but I call those fixed variable payments. They're variable payments, but they're fixed in substance. They're not going to change, and they're known at the date that you signed up for the agreement. So you just bake those into these calculations. So in this case, since this client has elected to include the CAM charges in the calculation of the lease liability, it's just going to result in a little bit higher lease liability. Now, if those CAM charges were, say, $500 a month plus some sort of variable consideration which wasn't known, plus I'm trying to figure out what a driver of CAM charges would be, but say they said our CAM charges are $500 a month plus 5% of your company's net profits. I understand that's not super as somebody typed in insurance and property tax. Perfect. If that's the case, insurance and property tax, since those are variable in nature, you wouldn't necessarily include those. Those would just be included in your period expenses. They'd be expensed in the period they're incurred, because those are variable payments. They don't factor into the calculation of the lease liability. So I hope I answered that. If not, let me know in the chat. Real quick, just because it's weighing on my mind. Now, a third example, what if those CAM charges were $500 a month plus the plus annual escalator based on whatever the consumer price index for, state of California, or I don't know, Stanislaus County or Contra Costa County, California, right? Since the DOL publishes the consumer price index, I think it's the DOL, since that's a published rate and it's known at the time of the lease inception, that rate would get factored into the math that generates out the lease liability. So you would just take that percentage rate and escalate it every year by that rate. And people say, well, Dave, but that changes every year. It doesn't matter, because what the guidance says is it's based on the facts and the circumstances that existed at the date of adoption. For this example one, that's January 1st, 2022. So whatever the consumer price index was doing at January 1st, 2022 would be the rate that you would use to escalate the CAM charges included in the lease liability every year until the end of the agreement. Actual future changes in the consumer price index, which may increase or decrease the payments based on what your liability, would just go through income or expense in the period incurred. They would not affect the lease liability. It would be based on the static, whatever the CPI was doing at 1/1/22, because that's a known rate. So hope that kind of demystifies variable payments, because that's an important and confusing concept. And then this is just kind of a summary that takes us through kind of the full-on balance sheet income statement impact for under the old lease guidance here on the right and the new lease guidance on the left. So one quick little detour before we get away from this example one is what if we had a deferred rent balance, which happens all the time, because we know if we have a building rent with escalating clauses, that's going to we have to smooth out those payments per legacy gap and take those payments, and that's going to, the earlier years you're going to have a liability which is going to be reduced in future years, right, by your cash payments. Well, say in this case we had a $17,143 deferred rent as of 12/31. What does that look like? Well, your lease liability doesn't change because it doesn't affect your lease liability math. So that just gets added back into our right of use asset. So the right of use asset would just be you clear out the deferred rent and you take it out of the right of use asset. So the deferred rent would, ostensibly that's deferred rent is a credit balance because it's a liability that's going to come off the books here, and then it's going to go to reduce your ROU asset. So another kind of frequently asked question. And then this is just how it kind of changes your subsequent accounting. Really important to understand lease term. We already kind of talked about this a little bit. The lease term is the non-cancelable period, which in example one was 5 years, right? For which the lessee has the right to use the asset. It's the period for which the contract is enforceable. Well, how do you evaluate the lease term when cancellation clauses are present? If only the lessor has the option to early terminate, assume that it won't be exercised. If only the lessee has the option to early terminate, then you assess the lease at inception whether or not it's reasonably certain. So if the lessor, you assume, kind of how I remember this is the lessor is kind of going to always want their sale, or they're always going to want their money. So you, if only lessor has the right to get out of the agreement, you just assume that it's reasonably certain they won't do it, and you ignore it for accounting purposes. If only lessee, which is what shoes we're going to be wearing in most of these transactions, if only the lessee has the right to early terminate, then we have to go back and say, okay, is it reasonably certain that they're going to exercise that option? Remember, reasonably certain is a really high hurdle. If either party has the option to early terminate with no more than an insignificant penalty, maybe the only penalty is whatever they have to pay the rest of their rent in the month they notify you in or whatever, then the lease is no longer enforceable. So if you have a 5-year lease, but either party has the right to terminate within a month's notice, then you really don't have a 60-month lease, do you? You really just have kind of 60 one-month leases strung together. So that's termination clauses. So the lease term is based on the legally enforceable terms and conditions of the lease. So the question that we get all the time is, can the legally enforceable terms and conditions of a lease between related parties include terms that are written outside of a contract? And the answer is, it depends. We don't know. And I'm going to kind of leave it at that because we're actually working on an exposure draft. FASB is working on an exposure draft. I believe the invitation to comment is either just recently ended or ends very quickly. And Wifley actually submitted responses to it that helps clarify some of the accounting for related party leases. So if you have related party leases, my best advice is stay tuned, see what happens with this exposure draft, which is going to result in new authoritative level guidance for how to treat lease agreements. So how do you evaluate the lease term when renewal clauses are present? You have to determine if the entity is reasonably certain to exercise the renewal option. So if they're not reasonably certain, you ignore them. If you are reasonably certain, perhaps 75, 80, 85, 90%, then those are included in the lease term. So in our agreement, we had a 5-year original term with a 24-month add-on. We thought that the 24-month add-on was reasonably certain to be exercised, so we included that in our lease accounting there in example 1. How do you know if you're reasonably certain to renew? Well, we have a couple slides on this, but what we have is contract factors, asset factors, entity factors, and market factors. And I can kind of take you through here, but these are kind of the questions you have to ask yourself. Are there aspects of this agreement which are going to indicate we're going to stay in it longer than just the original term? So the example I threw out there as assets as like a bank with a branch, right? And say they lease just the shell of a building, they want to turn it into a bank branch, and they have all these sorts of leasehold improvements and things like safety deposit boxes and little air tubes that transport the checks and the pens and stuff. And those are all, 8, 10, 15-year property, right? And they enter into a 3-year agreement for the shell of a building and they put all this money into it. We can reasonably assume that there's asset-specific factors that are going to keep them in that building for longer than that 3-year agreement, because they're going to want to amortize the cost of their safety deposit boxes, their safes, their air tube systems, all the improvements they put into it. So that's an asset-specific factor. And then market-specific factors, are they leasing it at below market rent? So is it more advantageous to stay in the old building as opposed to go out to market every 3 years and find a new one, which is potentially going to cost them more? And then entity specific factors, is this bank branch on a specific street corner where everybody knows, hey, this US bank is always on the corner of Hawthorne and First or what have you? That could potentially keep you in a lease, be a factor that keeps you in a lease longer than the original agreement. So I'm going to kind of breeze through the last elements of the lease term, because I feel like we talked about that a little bit, but I want to at least touch upon transition methods in our limited time here together. We talked about the effective dates already. For public entities, it's earlier than private entities. Private entities, it's December 15th, 2021. Fiscal year is beginning after that date. So we have 2 methods for transition. One of them is the retrospective approach, where say you have multiple year financial statements, 2-year financial statements, you're doing 12/31/22 and 2021 in the same financial statement report. Full retrospective just means that you kind of reopen that 2021 column and do full on ASC 842 lease accounting in both years. The modified retrospective approach says that if you don't want to go through rigmarole of going through and restating some of the amounts in 2021, you can just do a catch-up adjustment in 2022 through the opening balance of retained earnings for any expenses that might have changed or what have you. So it means that you only have to reopen 2022 for accounting purposes. Now, don't let that fool you. It does simplify your accounting a little bit because you have to do fewer journal entries because you don't have to go into a previously closed period and kind of redo the lease accounting. But if you're doing the modified retrospective approach, then you're literally issuing financial statements on 2 different sets of guidance, ASC 840 and ASC 842. So that means that you're going to have like 2 sets of disclosures for leases in some cases. So your disclosures may be a little bit more hard to prepare in the notes to the financial statements, even though your basic financial statements, the balance sheet, might be a little bit simpler to prepare in this case. So those are your 2 options. And whichever one you choose is going to really drive the accounting. So if you do full retrospective, then your period of implementation, if you're a 12/31/22 year end, your year of implementation, your year of adoption, that's going to drive a lot of this accounting for leases that existed at that date is the payments remaining at 1/1/21, not 1/1/22. So something to consider there. So we just have kind of example of what I was talking about with the transition methods. And it looks like I'll just have time to kind of introduce you to the 3 so there's 6 practical expedients under 842. So these are things that are kind of meant to make your life a little bit easier. There are 6 total practical expedients. There's 3 transitional and 3 other non-year of transition practical expedients. So transitional practical expedients, these are going to be the first 3 that we talked about. It's kind of confusing because the first one is actually 3 lumped together, then the second 2 are those first 2 that I popped up on the next page. But the first one is called this package of 3, and the reason if it's a package of 3 is because you have to elect all of them or none of them, which says, first of all, like I mentioned, no need to reassess expired or existing contracts for embedded leases under 842. So if you've already done that under 840, you don't have to reopen and reinvent the wheel and say, okay, do we have embedded leases? If you already did it under 840, you don't need to redo it under 842. Lease classification, we already talked about this, where if you properly accounted for leases as capital leases under 840, you can now just call them finance leases. If you properly accounted for them as operating leases, you can now just call them operating leases. Initial direct costs under existing leases do not need to be reassessed under 842. So initial direct costs weren't really a thing under 840. They are under 842, but this is kind of a get out of jail card for dealing with that. So it's important to know you can't just cherry pick these. You have to select all or nothing, and these are only available in the year of adoption. After the first year that you adopt, then you're kind of on your own. Next one is the hindsight practical expedient. This one is probably the least well known to me because my clients usually don't adopt it because it actually creates more work, but it's used in determining the lease term and or impairment of existing leases. So since it's kind of onerous to use and not really useful, and not well understood, most clients don't elect this. And then land easements, if you have contracts for land easements, you don't need to reassess expired or existing land easements for embedded leases under 842. So those are the 3. One of them is a package of 3, but those are the 3 practical expedients available to you in the year you originally adopt this guidance. And then your policy elections, your other practical expedients include the short-term lease exception, which you can apply not to apply lease accounting to contracts with original lease terms of 12 months or less. Now, we run into this all the time where you'll have an existing lease with 12 months left on it or 8 months left on it as of the date of adoption. No, it goes by the original term of the contract, not the remaining term of the date of adoption. So if you have a lease with an original term at the date of commencement of 12 months or less, then you have you can apply short-term lease accounting if that's your policy election. You can apply the practical expedient to not separate out lease and non-lease components. So like in our example with the building, you can elect to include those CAM charges in the calculation of lease liability, which may result in a higher lease liability, but it's going to make your accounting a little bit simpler because you don't have to bifurcate that transaction into, okay, some of this is building expense, some of it's rent expense, that sort of thing. And then we talked a lot about this last one, number 6, the ability to use the risk-free rate for a comparable lease term. And so with that, we're completely out of time for an hour. I'm available for as long as you guys need me to answer questions. I'm not sure what your timeline looks like, but the subsequent slides definitely do kind of unpack these in a little more detail, but I'm glad I got a chance to at least introduce them. And I'm really glad that I got a chance to take you through some of the debits and credits, because I think that's where a lot of the questions come in is what does the accounting look like? I know for most of my clients, a lot of the questions surround how do we apply the discount rate and how do we determine the lease term are the two biggest things. So if you're going back and revisiting the slides, those are the two biggest areas I would review here and at the lease in the lease guidance. So I see we have, hi Lawrence. Have a couple questions here. Like I said, if we have time, I can go ahead and answer those.
Yeah, David, thank you for that. As people have other meetings, I did drop a link in the chat there for feedback. Just a simple question. We appreciate your feedback. David, if you'd like to answer some of the questions that were in chat, or if anybody wants to come off mute, I guess we could do that now too.
Sure. I'll start with one that came through the chat about expired leases. So if you have an expired lease, and then the term goes month to month, is it then not considered a lease? So what we have to look at is, does the lease, so assume we'll kind of throw out some hard dates here to kind of make this a little more concrete. So we'll say that our date of adoption is January 1st, 2022, same as our example one that we went through. And the lease expired, we'll just say on September 30th, 2022, so or 2021, prior to our adoption date, so that as of the adoption date, you're just in this month-to-month agreement. If the agreement says that, if the agreement says that either party can cancel with just a month's notice, so you have, if the lessor can cancel on you, if the lessee can cancel, and the only thing they're on the hook for is that next month's payment, and then you really have a non-enforceable agreement. So what you have then is you still have a lease, but you don't have any sort of enforceable term. You don't really have, maybe in that sense, you don't really have a lease agreement because you don't have that time element. If only, if only the lessee can terminate, then we have to look at what the reasonable certainty is. So if they're reasonably certain that they're going to terminate within less than a year, then you could just apply short-term lease accounting. Then you don't really have the concepts of 842 don't really apply, because you could just make the short-term lease exception. So you really just have to look at whether this is an option to renew, an option to terminate, and who holds those options and how reasonably certain they are to exercise those options. So on the flip side, if these are renewal options present in the contract, if the contract says 5 years expiring September 30th, 2021, and here you are 1/1/2022 figuring out what to do with this, but then you have the option to renew, without, if you take no action, it just automatically renews. What you have to do then is figure out as an entity, how likely are we to stay in this agreement and for how long? How many of these 1 month renewal options are we going to string together? So I just covered kind of what the termination accounting looks like if they're early termination clauses, but if they're renewal clauses on top of this original agreement, how likely are you to renew? And then you have to go back and evaluate it on those different factors, which we didn't have a ton of time to spend on, but the market specific factors, the asset specific factors, the entity specific factors. So then it really just becomes kind of almost like an accounting election, is like, what's our estimate that we're going to stay in this agreement? That's a really, really common question, and that's a really difficult thing to unpack, but there's a lot of flexibility in the guidance for how you want to account for that agreement. The next question just asks about getting an answer to the one about a lease with renewal clauses, or with a kind of a month-to-month thing. So I think I unpacked that well, but if I didn't, let me know. And if there's other questions, I definitely ready for you if you want to throw those at me.
Well, I have a follow-up to kind of the discussion that we're having. We have multiple offices that were originally rented under a 1-year lease that are now 3, 4, 5, some of them 20 years past the original lease. We don't have any plans to vacate them. They are now considered month to month. All we have to do is give 30 days notice, but there is no way to kind of estimate the length of the term we're going to be in there, because at this point it's indefinite. How would you go about accounting for that? Or are you good just expensing the lease monthly and not putting it as an operating lease?
Yeah, so before you get into the how you treat it, if you expense it, or if you apply some of these capitalization type of principles to it, first of all, we have to look at the agreement and see, can the lessor cancel on you at any time, or is that privilege only available to the lessee? If the lessor and the lessee both have the right to get out of it, then you don't have an enforceable contract for really any period of time longer than 30 days, right? If it's a termination situation where only the lessee, the lessor can't kick you out, if only the lessee can kick you out with 30 days notice, can kick themselves out with 30 days notice, then we have to go back through and understand if that's reasonably certain to happen or not. And if it is reasonably certain, then we don't worry about it, because then the contract's going away. But as you said, you have no plans to do so. But even though you don't have any plans to do so, does that mean are reasonably certain to exercise all these renewal options? So that covers the, you have to read the contract and understand, is it a early termination option, or is it a renewal option on top of an exit? So then if it's a renewal situation where you're allowed to renew every month, and you're basically considering this a new agreement, a renewal of an old agreement, if you will, every single month, if no action is taken by either party, then you have to go back and say, okay, how long are we reasonably certain to stay in this building? If that's 11 months, great, you're in short-term lease accounting. You expense the payments, you exercise the short-term lease expedient, and you don't apply the capitalization principles that we kind of took you through. If that period's greater than a year, then you have to determine how much greater, and then you're in the territory of having to capitalize however many months that is into the math that determines the agreement. And that's the biggest thing that I think that's the biggest thing that clients all over the place are struggling with, because they're being kind of forced to make these determinations that affect their accounting that they've never had to really consider before. They're like, well, I don't think we're going anywhere, but we just have these buildings and we just kind of pay and they just kind of accept. And so you really just have to read the agreement, find out if it's a termination option or renewal option is the first thing, figure out who has the options, if it's the lessor or if it's you. And then from there, just kind of march through the fact pattern and the guidance in the lease term slides that I'll provide to you, and kind of make a determination of what that accounting looks like based on, what you can, what GAAP says. And I'll finish my answer with this: is, as you can see, a lot of this is determined by your own estimates and your own considerations for your own circumstances. So depending on kind of what these circumstances look like for each individual entity, it's going to be a little bit different. And since there is flexibility in US GAAP for how this accounting is done, I highly, highly recommend reopening your accounting policy manuals and your policy manuals and writing some of this into policy for how you consider these types of transactions, what they look like in terms of US GAAP. The reason I say that is because my primary job is not providing training for organizations and internal parties. My primary job is as I audit financial statements of external parties. So if, Chris, if I'm coming on site and I'm asking, okay, let's talk leases, and you're saying, okay, these are month-to-month leases, we're expensing them, we're not capitalizing them, I'm going to say, okay, why? And you're going to say, okay, because we don't consider them to be long-term in nature, because we can get out of them at any time. And I'm going to say, okay, what did you consider this and this and that? And at some point, it kind of becomes a judgment versus judgment thing. Do you want to leave that open to somebody else's judgment to be able to tell you, oh, we should adjust this in your financial statements because, we have a different take on US GAAP, versus if it's in your policies and you can demonstrate to me that you're following your own written policy, I don't really have a leg to, if it doesn't result in a violation of US GAAP, I don't really have a leg to stand on to tell you you're doing it wrong as an auditor. So that's a really good place to start when you're thinking about these accounting policy elections and how you consider, the guidance just on talking about renewal options uses the word reasonably certain a lot. But it doesn't really define reasonably certain. That's space for you to go in and say, if at the time, annual financial statements are issued, if we haven't renewed yet, or if we're not more than 12 months out yet, then we're not reasonably certain that we're going to be in it for another 12 months or what have you. So I think that's a really good area that you can write into your policies and be really thoughtful in your policies about that.
Could I summarize what I'm hearing and make sure I'm hearing it correctly?
Oh, absolutely.
If we were to go into our accounting policies and say that we're going to follow 842, or is it 862?
42, yeah.
42, and we were going to follow the guidance on all leases, operating leases, and capitalize them as is stated. And then also with a follow-up that once any lease moves into a month to month, if there aren't any, if it moves month to month and there's no longer a defined period, we are allowed to move it back to just a tradition, what you're calling the legacy operating lease. If we kind of codify that in our accounting policies, that we follow it during the lease term, but once it's moved out of the lease term, we will just use them, expense them, and go month to month.
Yeah, I think there's space to do that. I don't know, I know we're obviously kind of trying to just spitball this policy on air kind of as we go. So I don't know if I would analogize to legacy guidance, because that guidance has been superseded. I would more just say hey, we consider all month-to-month leases as a matter of accounting policy to fall under the short-term lease guidance as allowed under ASC 42-10-50.
Short-term exemption.
And then I would even put in the super nerdy ASC 842 and the paragraph for where the short-term lease exemption is. And then you can even throw in kind of some of your thinking, because we don't consider ourselves reasonably certain to stay in any given contract for more than a year past its stated expiration date. Boom. If you had that, I don't know, I'm sure somebody would disagree somewhere, but at me as an auditor, if I saw that, I'd be well, really good job on documenting this. I can tie out your accounting to your policy. I'm happy.
Well, that makes sense. The consistency and the doing what is in the approved policy by the board, that makes a lot of sense. I appreciate it.
Yeah, a lot of what we do as auditors is really just matching up your policy to what your accounting is. So there's definitely a lot of areas in this guidance to be able to update your policies to conform to the guidance, and then fill in some of the gaps for where the guidance is either silent or vague, or just gives you that flexibility as a matter of design. What I tell people all the time is US GAAP is a little bit like the United States Constitution. The United States Constitution, as we all know, provides for a Supreme Court, right? But it doesn't tell us how many people have to be on it, what the composition should be, that sort of thing. So it's up to other areas of the legal realm to kind of fill in the gaps in the US Constitution. And sometimes that comes from state law, sometimes it comes from court law, sometimes it comes from what's it called, executive orders and that sort of thing. So similar with US GAAP, it just tells us things you just have to amortize the asset. It doesn't say you have to straight line it. So you have to determine how you amortize the asset. Similar to that, you have to consider what you think is a reasonably certain holding period, or what you think is 70, what you think is substantially all, that sort of thing.
No, and it's very good. We're up this year for our org standards, updating our accounting policy. So this is actually 2 birds in 1 stone.
There you go. That's very timely. Good to meet you. So Lawrence, I have those slides ready to email you. I'll send those, within just a few minutes of closing out here. But if there's no more questions, we can let everybody go. But if there are questions, don't be shy.
All right, David. Yeah, we have your email. So if anything else comes through, I'll pass it on.
Sounds good.
And for everybody else on the call, stay tuned for a recording. You can pass that around, and I'll also include that link for feedback. I appreciate your feedback. And thank you so much, David, for joining us today. Really appreciate you and Whipfly. We look forward to more training in the near future.
You bet. Thanks for having me. Bye,
Thanks.
Lawrence.
Bye.